Hey, it's Ryan from the Option Income Advisor, and our trade of the week this week is for Alibaba. This is a stock that we followed in the past. We've written puts on it, but this is one that it's kind of in the news. I've gotten a few questions about it this week, so I wanted to cover it as our trade of the week because I think this is an interesting situation where we've got a stock that's come down significantly from a valuation safety standpoint. It makes a lot of sense. There's this overarching uncertainty with China, and that's why the stock has really come down, right? And so, we're talking about the Amazon of China here, right? I mean, the upside and the prospects for this company are huge, but there is that uncertainty just around Chinese regulations, right? And so we're going to look at the chart today, kind of see where the stock has been, where it's kind of come. At least this week it's bounced significantly, and it's still actually bouncing today. So I'm gonna kind of teach you a trade that you may have heard me talk about before, where we can structure a trade with options to be able to capture some of the upside that I think is probably there near term, but also protect us on the downside as well. So I think it's a good risk reward trade. Again, that allows you to participate in some of the upside. Unlike a pure cash secured put where you don't really get any of the upside, you're just kind of collecting that premium with that margin of safety. This trade will allow you to take advantage of some of that upside. So let's get into the analysis here a little bit. So just looking again at Alibaba, you can see yesterday it was up 8%. And again, I'm recording this on Thursday the 8th, kind of in the morning, and the stock's up a little bit more this morning. But the price at this point is, not as important because I'm going to show you the trade, and you could probably put it on all the way up to, say, 170, but it kind of has the same concept with it. So, you have to worry too much about price. But so from a safety value perspective, this is a great combination that I look for. A stock that has high safety, which basically means it has a strong balance sheet. It's got great kind of earnings growth and revenue growth historically. Just all around, just a good, fundamentally sound company. And then from a value perspective, high value rating means, from a relative value standpoint, this stock is actually trading at a really good value right now. So that combination, I feel like is if you can find that combination, it's really attractive. On top of that, obviously we have a very liquid stock here, which is great for options. It's pulled back a lot, which we'll talk about, and we've seen, we're off still 50% from its peak. So this is a stock that has pulled back significantly. Again, it was never fundamentally driven. It was all uncertainty around China, and I think some of that is waning quite a bit. This is one of the larger stocks that trades, in the U.S., largest Chinese stocks that trades in the U.S., and it does have a very wide institutional base. And so, I think if you're going to play in China, this is definitely the one to watch. And so just from a, cash secured put standpoint as well, we always, give ourselves a strike zone on the cash secured put side, and I'll show you kind of why that's important with this trade we're going to look at. But again, just from a metric standpoint, I love Alibaba from that perspective. It is a great company. I think the future prospects are great for it. And so getting in even at this level, even as it's popped up, and quite frankly, so you're not catching a falling knife, and this is a good segue into just looking at the chart. You never want to try to catch that falling knife, right? You're trying to balance figuring out where can I get in, right? You're never going to time the bottom, just like you can never really time the top. And so let me scroll in here a little bit and just kind of show you what it's done. Just so this is obviously the longer term perspective. I mean, you see how this stock has clearly run up. Even back in 2019 is when it hit kind of the previous low of like 130, but it was in a very nice uptrend, pretty much all the way through, the end of 2020, right? I mean, it bounced significantly, it hit a peak of about 320. Did get caught initially in kind of the interest rate spike, kind of tech growth scare, but then, this was also when the Chinese kind of regulation uncertainty was kind of hitting, and it's just been a free fall ever since. And so, when it broke the downtrend there, that's where you kind of got to say, well, even though I believe in this, it's in a downtrend now, so I need to think about it from a different perspective. And so, we are still very much in a downtrend, and so you got to figure out, I'm not trying to necessarily time the bottom here, but you want to see, a big bounce and some stability off of some kind of base that you're building, right? And I think what it kind of looks like is given this was right around 130 where it hit before, and it looks like it's kind of stabilized or at least bounced significantly, right? You're looking for a significant bounce, kind of off the lows, and so just a few days ago we hit 140. And then it's bounced all the way back, intraday right now it's right around 160, right? And so that's a bounce I like to see. So I think it's probably going to consolidate in this area. This stock has definitely had a history of significant moves up and down, especially in the recent history. So let's just kind of scroll out a little bit now on this and kind of isolate this current move, right? And so if we're thinking of, where this stock probably could go just in the short term, I'm looking at this next kind of peak of, say, 175 range, right? And then I think 140, folks, that could end up being the kind of low point for this stock. What I want to see is it consolidate, in this area to feel really good about it. But the nice thing about this trade I'm going to show you, it's shorter term in nature, right? It's still kind of in that 30 to 45 day, time frame that we look at from a cash secured put standpoint. But you get to reassess where you're at, pretty much at the end of that trading time frame, right? And so I want to see this stock consolidate. I think in the short term it does probably have some upside. To say 175. If it breaks through that, great. I think, then the next move there is 200. And I don't think there's any reason why in the next 3 to 6 months, this stock could hit 200. No question, because just from a earnings standpoint, you think about forward earnings, and, you saw that this one had a valuation of, or a value rating of 9. That's based, forward earnings, it's trading at right around 14 times. And I think their forward earnings per share was right around like $11 a share. And so it's trading at 14 times now, which is kind of ridiculous for, what this company is. So I think even some multiple expansion up to, say, 20 times, which wouldn't be crazy, right, for a stock like this to trade at 20 times. You're talking about that equals about $220 a share. So I think there's no reason why, just from a conservative standpoint, this stock can't go to 220. Probably in the next, again, 3 to 6 months. I think more of this uncertainty needs to wane a little bit. But what we're looking for is just we're looking for a situation where we know that it could potentially trade down to this 140 level again. If again, overall market uncertainty, China uncertainty, that kind of stuff, it is a volatile stock, so it's probably not going to be in a straight line up from here. But we're going to be looking for this consolidation and looking for ways to benefit from this stock moving kind of off of this base and as it kind of forms this base. And so that's from the chart perspective. So now let's take a look at, again, here's here's what I'm talking about with the PE. So the current forward PE is right around 14. So again, historically, it's always traded above 30 from a PE perspective. So this stock could theoretically go to 300, but I think just conservatively, thinking about that 200 to 220 level isn't out of the question. So how do we play this? Let's talk about how we play this. I'm going to give you kind of just a brief introduction, because we're going to do what I call the triple play. So you kind of know what we do with the triple income wheel. And I actually have a slide here. I can just kind of show you because it gives you some perspective on kind of how we can trade this. But our main strategy with what we do with our portfolios is the triple income wheel. We sell a lot of puts. We use that to acquire stock. If we don't acquire stock, it doesn't really bother us because we're collecting the premium. And that's really how we're managing the risk of our portfolio, right? We're collecting this premium. We're trying to collect, enough to get kind of equity-like returns, kind of that 8 to 10%, over the long term, with as little volatility as possible, in our portfolio. And we do that through the margin of safety we get in the put, right? But as we sell puts, sometimes they get exercised. Or assigned. A lot of times they expire, and we just kind of rinse and repeat. We keep selling more puts. When they do get assigned, we own the stock. We're going to sell covered calls. We're going to collect, any dividends. We're going to catch some capital gains if we can. And again, rinse and repeat that on the call side. And as capital flows back up, we kind of finish this kind of wheel process. Now, a triple play is essentially the triple income wheel, but what we're doing is we're jumping ahead a little bit, and we're going to simultaneously sell cash secured puts on a stock that we've purchased that we're also selling covered calls on, right? So the triple play really is we're getting put income, we're getting call income, and hopefully what we're getting is, if it's not a dividend stock, we're getting some capital gain upside. And then we're also getting some dividend income if it is a dividend stock. So that's the triple kind of income part of this particular trade. But we're getting all three, right? So that's why I call it the triple play. So the way you kind of handle this, and the way I like to do it, is let's say you have a certain size of trade that you want from a dollar perspective. So I always talk about like a $500,000 portfolio. Our maximum trade size is usually about 5%, and so that's how much we'll use capital wise on a max trade basis, and so that equals right around $25,000. So from a perspective from just a trade, we're going to take a look at this and say, Bob is trading right around 160 right now. So if it's a stock I like, I might go a little bit above that kind of 25,000 range, for example. And so we're going to look to do about 50% of our position in the stock, and then about 50% of our position in puts. And so because this one's trading right around 160, two contracts would be about 200 shares, right? So that's right around $3,200. So it's a little bit more than our max position, but I'm okay with that given how much I kind of like this stock. And so what we would do with this trade is, so we're going to do again 50% of our position, which would be 100 shares or one contract on the stock side. And so we're going to buy 100 shares, and then we're going to sell one call contract, okay, upside call. So what this does is it gives us that upside I was talking about, right? So we're going to get some upside in the stock if the stock continues to run, right? And we're going to set our call pretty high so that we give ourselves some room. And this one's good because it's actually pretty volatile, so we can get nice premium. And so what the call does is it kind of cushions the fall if the stock comes down a little bit. So it's not a perfect hedge. There's still, you still can lose on this stock if the stock trades lower, but it gives you just a little bit of cushion there from the call, but it does give us some upside. And then by selling a put, it gives us, so we'll also sell one put contract, which would give us a total, basically a total position of about 200 shares, right? So there's 100 we're going to buy outright. We're going to sell one put, which is another 100 shares at a lower price. And so what that does is it gives us additional cushion. So you kind of add the call premium you get, and then you add the put premium you get, and that gives you additional, kind of a margin of safety on the stock if it does trade down a little bit. And then if it does trade down to our price, and we're going to set our price right around that 140 level, because I think that's where that real support is. If it does drop to there, we're basically going to average down our position. So if we bought some at 160 today, for example, and we averaged down, basically doubled our position at 140, we'd average, our average position size would be at 150 minus all this premium we're getting, right? So that's our downside protection, but we're also going to give us some potential for the upside. So I'll show you some of that numbers there. So that's what we're going to run on, this particular trade. Is we are going to run the triple income. And so let me get out of this. And so let's go back to the stock profile here. And so we're going to look at, and again, these are yesterday's prices, but again, this is more of an exercise of just kind of what to do, and I'll kind of show you what we're looking at here. So first, I guess let's look at the covered call first, because we're assuming we're buying some stock at, say, 160 level. And so what we're going to want to do is we're going to go out to November, because October expires next week. So we're going to go out to November. So it's roughly 42, 43 days out. And so we are going to look at some upside calls. And remember, there was kind of some resistance, if you will, right around the 175 level. And so, we could take a look at something kind of in the 170 to 190 range. And so really this is just the trade-off of how much we're getting in premium, which again is going to help offset any downward movement in the stock as much as it can. And then the upside profit, right, is the other thing we're balancing, right? How much upside profit do we have from the current price to, the strike price of the call, which is here. So how much room do we have from the 160 up to the 175? And then the upside profit includes, this option premium we're getting, for example. And so I kind of like the 175 here. It gives us almost 2% of an average monthly yield, over the 43 days. But it gives us 15% of upside, right? So we're not trying to be greedy here, trying to capture every single dollar of upside. But what I'll say is that if you can find that balance, if this trade executes properly, we're going to get 15% of upside on half of our position, right? Because remember, we're only buying 100 shares here, which is half of our total position, and we're using the other part of our capital in the cash secured put. So we're going to get 15% upside on half of our position, right? And if that happens over 43 days, we're going to be ecstatic. And so what else do we get? So keep this in mind. So we're going to go out $4 for selling this upside call. And again, if you're looking at this tomorrow and the stock's a little bit higher, you might be able to go up to the 180 and still get some reasonable premium up there. Target somewhere in the 1.5% to 2% range, if you can, on the average monthly yield side. And then if you can get 15% upside, I think that's a great level from here, because I actually do think that this stock could move that high in the next couple months, 45 days. And so that's the covered call side. On the put side, so again, we're going to do another half of our position on the put side. And remember, we saw that 140 level as kind of that support that we're looking at, right? And so again, as this stock moves up a little bit, this can change a little bit. But I think this 140, even at the 160 price now, you're going to get over 2% on that, right? So that's still having a delta under 30. So you could go down to the 135 if you wanted to. That's still over 2%. But I would again target something in that kind of 2%ish range. Delta under 30, feel pretty good about that. But anything under 140 or equal to 140, just given where we know that support level to be, I think is pretty attractive. So now let's talk about what do we get from this trade. Okay, so just from the perspective, let's say we do the 135. We're getting that 2%. We're getting another basically $4 a share. So we're going to get $4 on a call, $4 on our put. So we're getting $8 of premium, right, that we're collecting. And if you bought the stock at 160, right, you're getting an $8, which is roughly, what is that, about 5% of kind of downward protection, right? So your actual cost basis on this position, assuming it stays above your strike price of your put, and that expires worthless, right? You collect that $8 on essentially $1,600 or $16,000 of capital, right? And so, your average price there would be about 152 on that stock that you bought. So again, assuming that stays above that price. Total return though, right? Because we're using about $32,000 of capital over these 43 days. So if that stock went up and hit our price, right, we're going to get about 15% upside, right? If it goes up to the 175, for example, and we sell this stock through the call, we're going to be about 15%, which again included that $4 from the call, and that's on half the position. And then our other half of our position, we're getting about 2%, right? So it's 17% divided by 2. So our average return is about 8.5%. So we're going to get about 8.5% average return on our total capital used with this trade. So I really like that, right? So we've got about a 5% real cushion before we lose money, right? Because our break-even price, again, assuming it stays above the 140 or 135 level that we're hitting. So we've got some margin of safety here, but we're giving ourselves some upside, right? This is a stock that I do think could continue to move. It may be a little bit volatile. I don't think it's going to hit down below 140 again. So I really like this triple play kind of format that we're looking at here. So, and I think that you would agree, if every 45 days, if we can get an 8.5% return on something, I mean, that's a trade that I want to do all day long, right? But I think the way we're structuring this, it just makes a lot of sense from a risk reward standpoint. So I love the triple play for Alibaba. Any questions on this? As you know, just feel free to email me. And hopefully you enjoy this trade and get in it. Take care.